To HSC revision, part 1 on operations. Basically, we're just going to talk about what is operations and what are the processes involved behind it. The first section you'll find in the course is talking about transformation and value adding. Basically, how can the value of a good be worth more than the sum of the parts put together, which is the concept of value adding. Operations is basically involved in transforming some product or service, adding some value to it and then selling it to your customers, and the difference being a profit. Through transformation and value adding, transformation is also known as production, the process of turning raw materials into a product, taking your flour, adding some yeast and water, baking in an oven and turning it into a loaf of bread, for example. Value adding is basically this process, or the process of operations. So it increases the value of the raw materials or service that the customers will pay for the added value. Naturally, a loaf of bread costs a lot more than the combination of yeast, water, and flour that you could buy from a supermarket. The role of operations management is to basically oversee these processes that are value adding, developing your service or your product. It overlaps and is interdependent to all the other business processes, so marketing, finance, and human resources. Basically, we can see in this business inputs are what we consider the raw materials in a manufacturing process, or the knowledge of a knowledge worker in the service industry. Basically, the operation processes are how we transform our raw materials and come up with a product. Related to these, marketing is how we sell that product or service. Finance is how we fund it and charge for it and recoup the money that we've invested. Human resources is how we find and manage the people that we need to do the processing. All together basically makes up operations. The textbook talks a lot about inputs and outputs in terms of operations. Inputs include tangibles such as the raw materials, the flour, the water, the yeast, the land, basically the factory where you're building or manufacturing your stuff, labour, the people you're using to do the processes, any resources such as electricity, gas for the ovens, whatever else you need to do to make the process, and capital, basically capital investment in machinery, the ovens, the factory itself, and any technology used to do it, your ordering systems, your manufacturing systems. It also includes intangibles such as ideas. People who come up with new recipes for bread, you want to differentiate your bread from the competitors, to come up with a new idea, that's an intangible. And the information you use, basically who are your customers, how much you're going to charge, how much is it going to be worth. The strategic role of operations management, as we stated earlier, operations overlaps all the other essential business functions, and each of them has a strategic role to play. This means they affect all the key business areas and have an influence on the strategic plan of the business. One of the main aims of the business is to maximize profits. Naturally, this can be done in two ways: either sell more or spend less on developing your product. So selling more means increasing revenue. In terms of finance, this looks at profit centers, look at ways that the business can actually develop income. Sell more, sell a wider variety of profits, do more marketing, whatever you need to do, open more stores. The other way we can do it is decrease costs. Do things cheaper, manufacture elsewhere, reduce your cost of manufacturing a product. The difference between if you sell the same amount and it costs you less to do it, the difference is a profit. So cost centers, in terms of finance, look at areas that are incurring costs and how do we reduce those. So your operations managers are looking at both of those ways. How do we make more with less, and how do we spend less making what we are making? So operations is considered a cost center. The most obvious way for operations to increase profit is to reduce the overall operational costs. Do things more efficiently, do them cheaper, try to use cheaper ingredients without reducing the overall quality. Would be a classic example of this. This diagram is basically looking at the different types of costs and operations managers are looking to reduce these as far as possible. Input costs, things like your capital and land, how much it costs you. So if your finance department needs to borrow money to build a new factory, they're looking to get the cheapest interest rates possible. The land, maybe building them somewhere else. For example, a remarkable success story in Australia at the moment is a company called Bird's Nest, which makes women's clothing. They're based down in southern New South Wales city called Cooma, a long way away from anywhere, but has a cheap land, cheap factory, and relatively cheap workforce. The resources you're using, the interest on the investment, leases on machinery, installation and testing are all input costs. Right? So developing your factory, testing, getting it set up and run. Often the most expensive cost in the amount of manufacturing is the labour costs, the mix of full-time and part-time employees, casual employees, contractors, overtime, cost of recruiting and training, the cost of redundancy, the cost of rostering. Basically, all these factors need to be taken into account in your operations setup. If you can get people to work more efficiently, you need less of them. Therefore, your costs per production unit go down, meaning your profit will go up. Your processing costs, machinery maintenance, electricity, scheduling, product design, template and tooling, prototyping. Basically, every time you introduce a new product, you need to prototype it, you need to manufacture or reconfigure your production line, new tools, new templates. These things all cost money, so naturally you don't want to do it with a small production one, if at all possible. Your inventory costs, basically things that are on back order, your logistics and distribution costs, how you get things, move your raw materials into your factory and then move the finished product out of your factory to your markets. What it costs to store, with warehouses being very expensive, your ability to manage your inventory, insurance, deterioration, shrinkage and theft, damaged goods, all things that are need to be taken into consideration, particularly if you're manufacturing with fresh goods. They only have a limited shelf life. You need to manage those very well. Inventory is a thing that can really get out of hand very quickly for an operations business. Your quality management, basically, there is the quality management triangle we often talk about. You can have either two sides of the triangle. You can have a good quality product at a low cost but takes a long time to manufacture, or you can have a fastly manufactured product, low cost, it won't be as good a quality, and any of the other options of the quality triangle. But quality management obviously has a cost, so reducing your loss through quality planning and training basically reduces your cost, therefore again increasing profits. How you go about doing your quality management, there are a number of ways that businesses do this, and it's looked at later on in the course. One of the things that businesses try to do, and particularly manufacturing, is adopt a policy of cost leadership, trying to reduce their costs to be the most price competitive in the market. So this puts a lot of pressure on operations managers to find ways to minimize the cost and make the price of the end product lower. If you can keep the price that you charge your customers up because you've got a good quality product but reduce your manufacturing costs, you are making higher profits.